I was in the US, I think, about 2 weeks ago, and every hedge fund, every macro fund I sat down with was bearish, just across the board. And I think the part of it is because I don't think a lot of traders have made money on oil this year. Sometimes they've kind of tried to get short, they've been caught out, and vice versa as well. So it's been a difficult year. But overall, the general message they were sending is that demand is weak. They're concerned about China, concerned about the US. But the flip side is inventories are drawing. So on a fundamental basis, it's okay. And geopolitical risks are rising. But you saw last week, it was definitely macro that was the driver, and we just had this massive meltdown.
To your point that it's been hard to make money on oil, just take a look at the Brent crude chart for this year, because you could see we were climbing, and there was a steep sell-off into February, started climbing again, and then we started to fall really after about the April mark, and you could see there were some steep falls in there. We start to recover, go back up again around the summer months, and then we fall aggressively from July into August. So it's very, very steep moves that we're seeing. To the point around what we were dealing with this morning, we think we could be talking about the prospect of a recession. That's the call that's gone into some of the big investment houses, from the likes of JP Morgan in particular, that are bearish at 50% probability, 25% on Goldman Sachs. Do you think the oil price is reflecting the possibility of recession?
Yeah, I mean, look, and we've got a big quant team as well now, and they're just looking at positioning of the different kind of types, CTAs, the high frequency guys, discretionary, and they kind of point out that basically every CTA in crude is short, almost max short now, precisely because it's kind of reflecting these recessionary fears, discretionary guys as well. But also now what's happening on the yen, like we think there's about 120,000 more shorts that need to be covered on the yen on the discretionary side, and vice versa on the USD long. So I think on both sides, you're getting pressure from purely the positioning on the macro kind of FX side and on the oil side, because these guys are trying to reflect a recession. Now, our house view is that August is always a bit of a tricky month when it comes to macro data. Plus, we've had Hurricane Beryl impact, plus all the kind of IT outages that we've had. That's what's actually reflecting in these numbers. If you strip out the noise, the data isn't actually that bad. But right now, the market's not going to listen to any of that, right? It's just full on sell mode.
Yeah, absolutely. And it's so fascinating because you have this push and pull factor going on with oil. On the one hand, the bull case being the escalation of tensions in the region, the bear case being the broader market sell-off that we're seeing right now. So, Amrita, where do you see the oil price moving from this point on, and what's the escalation risk in the Middle East right now?
So I think, I would say general path of resistance is probably still a little bit lower for prices. But because the high frequency guys are almost max short anyways, the risk is you get one geopol headline and then you just suddenly go up $3. And we think if we move $3, then they start buying again. In terms of the geopol risk, we still think there is no risk of all-out war. But again, risk of escalation or miscalculation is, of course, high. We saw it in April as well. It was more calibrated. We still think it'll be a calibrated response, but Iran will have to do something to show that they are responding to the attacks.